Welcome to the deep dive. We've got quite a stack of intelligence today. Really, a full geopolitical and market briefing. Covers everything from, well, Aussie inflation all the way to nuclear deadlines in Tehran.
A lot to unpack.
It is. Our mission, though, is pretty clear. We want to distill this down to maybe the 3 or 4 most critical, actionable insights you need to walk away with.
Exactly. We're aiming to get past just saying X happened. We want to pull out the why behind these market moves, the diplomatic shifts, connect the dots between currencies, commodities, trade, and all that global risk simmering away.
Okay, let's jump right in then. The currency chessboard feels like the right place to start. The U.S. dollar index, it showed significant strength during the Asian session.
It did, and that really put pressure on the euro, didn't it? We saw it dip below 1.18 for a bit.
Right before that German IFO survey came out. Now, for maybe folks less focused on Europe, what exactly is that IFO survey measuring? Why does it have so much weight for the euro?
Well, the IFO is crucial. It's polling German businesses on how things are now, the current climate, but also, critically, what they expect over the next 6 months. It's a key sentiment gauge.
So if the expectation part looks weak.
Yes, exactly. If expectations dip, it signals a potential slowdown ahead for Germany, the Eurozone's engine. Traders see that, they adjust their risk, and that puts pressure on the euro, hence that dip below 1.18 we saw.
Sentiment driving the euro down. Got it. Meanwhile, over in Asia, things looked quite different, some really sharp divergence, driven purely by domestic data, it seems.
Yeah, quite fascinating, actually. Look at the Japanese yen. It weakened quite a bit, USD JPY pushing up towards 148.
And the trigger was clear.
Very clear. It was poor PMI data. The Purchasing Managers Index number showed deterioration across, well, pretty much all components, manufacturing, services. When the business health outlook dims like that, investors tend to move away from the currency.
Okay, so yen weakness makes sense. But then you look south. Australia. The Aussie dollar completely bucked that trend, didn't it? Rallied back above 0.66. Impressive strength.
Really impressive. And the Kiwi dollar, the New Zealand dollar, sort of followed along, but the Aussie move was definitely more pronounced.
So what gave the AUD that specific juice?
It came down to inflation, pure and simple. Australia released inflation data that was hotter than expected. And that immediately got the market thinking the Reserve Bank of Australia might need to stay hawkish, maybe even hike rates again down the line. So the market saw a clearer path to tighter policy in Canberra compared to Wellington. That explains the Aussie outperformance, even with the U.S. dollar generally strong.
Okay, so domestic data driving these outliers. But that strong dollar is still having an impact elsewhere, especially on, say, the managed currencies. Sterling was pretty quiet, holding above 1.35. Seemed like it was waiting for comments from the Bank of England's green.
Yeah, sterling was subdued.
Wow.
But the real action, like you said, was with the managed currencies. Look at Beijing and Delhi.
What did we see there?
Well, the People's Bank of China, the PBoC, they set the yuan midpoint fix at 7.1077. Now, that was pretty much exactly in line with what the market expected.
Which signals what? Stability.
It signals they're comfortable, basically, that the current level of capital flow is okay. They're not trying to aggressively steer it one way or the other with the fix. But India, that was different. Reports came out confirming India's central bank, the RBI, was likely intervening quite actively.
Intervening where? Offshore markets.
Exactly. Intervening in the offshore non-deliverable forward markets to prop up the rupee.
Why is that intervention so significant right now? What does it tell us?
It really highlights that core tension, the strong U.S. dollar. When the dollar rallies hard, emerging market currencies like the rupee get hit. They become vulnerable to capital outflows.
So the RBI has to step in.
They feel they have to, yes.
Yeah.
They use their foreign currency reserves, mostly dollars, to buy rupees and support the exchange rate. It's a defensive move to prevent disruptive depreciation. And it shows how their policy goals diverge from, say, the U.S. Fed, which is focused squarely on its domestic inflation mandate.
That divergence costs real money, draining those reserves. Okay, let's shift gears. Because this interplay between the strong dollar and geopolitical jitters, it's clearly feeding into commodities too, starting with crude oil.
Right. Crude prices held onto their gains after Tuesday's rally. And interestingly, it wasn't really about physical market tightness driving it this time.
More about sentiment.
Very much so.
Yeah.
You had some pretty firm rhetoric from President Trump, sort of supporting price strength, providing a floor. And then you had these reports circulating that Russia might extend its ban on gasoline exports.
Supply side concern, even if just a rumor.
Exactly. So those two things combined kept the upward pressure on. Even though the private inventory data later showed a bigger than expected draw in U.S. crude stocks, which you'd normally think is bullish.
Yeah.
But the internals of that data, the components like gasoline and distillates, they are maybe a bit weaker than some bulls hoped. So it kind of tempered the reaction, prevented another big spike up.
Okay. And if geopolitical fear is partly fueling oil, it's definitely keeping gold looking resilient. Gold eased back a tiny bit, which makes sense with a stronger dollar.
Sure, textbook inverse relationship.
But it's still stubbornly high, isn't it? Above $3,750 an ounce, really close to record levels. If the dollar is strong, why isn't gold falling more? What's holding it up?
I think the answer is systemic risk hedging. You're right, normally strong dollar equals weaker gold. But the level of geopolitical anxiety right now, everything from those NATO airspace issues we'll get to the Iran deadline, it's creating this powerful underlying bid for gold.
So safety is trumping yield considerations.
Exactly. People are prioritizing perceived safety, capital preservation over chasing slightly higher yields they might get from holding dollars. That geopolitical risk premium is providing a very strong floor under gold.
Okay, risk hedging. Now, what about the industrial metals? Copper futures slipped back below that big $10,000 level. Was that just the softer risk tone and dollar strength again?
Largely, yes. Copper is very sensitive to global growth perceptions and the dollar. But let's dig into some of the more strategic stuff, because we got some interesting details on mine forecasts.
Oh.
So we saw specific forecasts from Peru's Antamina mine. It's a huge producer globally. They're expecting lower copper production this year compared to last year.
Which should be bullish for copper prices, right? Less supply.
You'd think so. But here's the twist. They also expect their zinc output to rise sharply this year.
Okay, so less copper, more zinc from the same major mine. What's the signal there for buyers?
It's not just numbers. It's a potential indicator of shifting demand patterns. The dip in expected copper output alongside rising zinc might suggest that maybe construction-related industrial demand, where copper is key, could be softening a bit globally.
But zinc?
Zinc is vital for things like galvanizing steel, alloys, die casting. Maybe suggesting the demand in non-construction manufacturing, perhaps automotive or specialized goods, is holding up better. It points towards a subtle shift in where the manufacturing demand strength lies.
Fascinating distinction. Now, here's where economics really slams into national security. This strategic nugget about the U.S. government in lithium Americas. Trump officials looking for an actual equity stake.
Yeah, this is potentially huge. We're talking about the government renegotiating the terms of a federal loan for the Thacker Pass lithium project in Nevada.
And as part of that renegotiation,
The reports indicate they are pushing to secure warrants, basically options to buy shares, later potentially worth up to 10% of the company.
wow, that goes way beyond loan guarantees.
Absolutely. This is about locking in national control, or at least influence, over critical resources needed for EV batteries, for the whole energy transition supply chain. It's about securing domestic supply.
But is that sort of thing, taking direct equity, something the U.S. government typically does? Or is this a real departure, signaling just how critical they view domestic lithium?
That's the million-dollar question, isn't it? Historically, the U.S. has favored subsidies, loan guarantees, maybe R&D support. Demanding direct equity in a private resource company is much more aggressive. It feels almost like wartime strategic resource procurement measures.
Like World War II kind of stuff.
You could draw that parallel, yes, where national security necessity overrides purely free market principles. Whether this becomes standard policy or if Congress would even sustain it long-term is up for debate. But the immediate signal is crystal clear. This administration views domestic lithium as a vital national security asset, and they want a seat at the ownership table, not just as a lender.
A massive signal indeed. Okay, so if that's the domestic strategy, how does this theme of securing interests and managing alliances play out in global trade agreements? It feels like the U.S. is trying to shore up key partnerships while also keeping trade partners maybe a little off balance.
I think that's a good way to put it. On the shoring up side, you have President Trump set to host the Australian Prime Minister Albanese next month. That clearly signals a deepening relationship with Canberra, a key Pacific ally.
And elsewhere.
And then globally, Trump endorsing Argentina's President Milei for re-election and pledging close cooperation with Buenos Aires. That signals a clear economic and diplomatic alignment strategy in Latin America, picking partners.
But then contrast that with the ongoing friction with Canada over the USMCA trade deal review. Prime Minister Carney sounded pretty firm.
He did. He basically said, yes, we'll keep talking with the U.S. as part of the review, but Canada's not signing anything until the terms are absolutely right for Canada. It's a straightforward defense of national interest, pushing back against being rushed.
And Carney also, interestingly, left the door open to talks with China about steel tariffs. That feels like a tactical move, doesn't it? Maybe adding a bit of leverage against the U.S.
It certainly looks that way. A little diplomatic triangulation, perhaps. And it fits quite neatly with how China itself seems to be positioning globally right now.
How so?
Well, Beijing's Commerce Ministry came out and confirmed China won't be seeking preferential developing nation treatment at the World Trade Organization anymore. That suggests a willingness to play more by established global rules.
While still seeking specific deals.
Exactly. And China's premier also signaled openness to improving ties with Canada, enhancing cooperation. So this gives Canada some potential breathing room, some flexibility if those USMCA talks hit a wall.
Global flexibility seems key, especially as the global risk picture gets, well, more complicated. Let's finish by looking at that global risk register. These are the things really driving underlying market sentiment, aren't they? We've got serious flashing lights around NATO airspace violations, Estonia, Poland, Romania.
Yes, and this creates a really difficult, immediate operational headache for NATO. You had President Trump suggesting NATO countries should shoot down Russian aircraft if they violate airspace.
Which sounds decisive.
It does. But then he immediately added this huge caveat that U.S. support in such a situation would depend on the circumstances.
So not an automatic Article 5 trigger, in his view. How does that square with the official Pentagon line?
It doesn't really square at all. The official line from the U.S. Defense Secretary was a very strong reaffirmation of Washington's ironclad commitment to NATO, calling the Russian incursions unacceptable. Plus, you had the G7 foreign ministers jointly warning Moscow about potential additional economic consequences.
So conflicting signals at the highest level.
Exactly, and that creates real operational risk on the ground. How does a country like Poland or Estonia plan a unified response when the leader of the alliance introduces this kind of ad hoc, depends on the circumstances clause to the mutual defense pledge? It breeds uncertainty.
Definitely complicates things. We also saw, speaking of Trump, quite a noticeable shift in his tone regarding Ukraine.
A really significant pivot, actually.
Yeah.
He stated he now believes Kyiv can fight to reclaim all its original territory, provided it has European and NATO financial backing.
That's a change.
A big change. He even described Russia as a paper tiger, citing its economic problems and military overstretch. Understandably, Ukrainian President Zelensky welcomed those comments very warmly. It signals potential continued support, which is crucial for Kyiv.
Okay, and finally, the really acute pressure point. The Middle East, specifically the Iran nuclear program impasse. There's a hard deadline coming up, right? September 27th.
Yes, this is potentially heading towards a cliff edge. European sources have apparently confirmed that, in their view, Tehran hasn't met the conditions needed to avoid a UN snapback of sanctions.
Can you just remind us quickly what snapback means in this context?
Sure. Snapback refers to the automatic reimposition of all the previous, much stricter UN sanctions that were lifted under the original nuclear deal, the JCPOA. It gets triggered automatically if Iran is found to be in significant noncompliance with the deal's terms by that deadline.
And Iran's position
Remains very firm. Supreme Leader Khamenei is maintaining that Iran isn't pursuing nuclear weapons, arguing their enrichment is still capped at 60%, which is below weapons grade, and basically saying further talks with the U.S. are pointless, a dead end.
Doesn't sound like much room for compromise before the 27th. Are there any diplomatic efforts still underway?
There are, yes. French President Macron confirmed he's meeting Iran's president this week, presumably to discuss the sanctions issue, try to find some last-minute path to avoid the snapback. The pressure is definitely on.
A lot riding on that meeting.
Huge pressure. And just on a slightly different note, maybe a glimmer of potential de-escalation elsewhere in the region, U.S. envoy Barrack suggested Israel and Syria might actually be close to some kind of arrangement to ease tensions along their border.
Oh, interesting. A small positive sign amidst all the tension.
Exactly. You have to look for those potential bright spots, too.
Okay, so if we try to synthesize all these different threads we've pulled, from the strong dollar hitting emerging markets to the strategic metals plays, the NATO uncertainty, Iran's deadline, What's the single most important connection, the main takeaway for you?
For me, the core connection we absolutely have to grasp is just how direct the causality is now between diplomatic rhetoric, political signals, and immediate market movement. Think about it. Trump's comments, even just rumors about a Russian export ban, they directly influenced crude prices.
Instantly.
Instantly. And at the same time, hard domestic data, like Australia's hot inflation print, created a genuine outlier performance in FX, completely separate from the broader trend. The global system is reacting in real time to both numbers and noise, to statistics and political sentiment.
So distilling that signal from the noise is crucial. I think we've done a good job of extracting that necessary knowledge from this pretty dense briefing today.
I hope so.
Right. And we can't leave you without one final provocative thought to chew on. We've seen these signals, maybe tentative, of major powers willing to cooperate or de-escalate. Think China and Canada potentially talking. That hopeful Israel-Syria arrangement hint.
Yeah, those little glimmers.
Now contrast that with the Iran situation. The snapback sanctions deadline is hurtling towards us, September 27th. Supreme Leader Khamenei is holding this very firm line. Negotiations with the U.S. are a dead end. So the question is, to prevent that snapback, which party, the U.S., Iran, or maybe the European mediators like France, is going to have to fundamentally adjust its core position? Someone likely has to blink. Watching for that adjustment, that's the key pressure point for you to track next.